Hello there, students. So today I'm going to teach you how to prepare depreciation by maintaining disposal account method. So let us begin. So this question was asked by Suman, and I'm going to teach you based on the exam question. Based on the exam question that appeared in May-June 2018, paper 2, June 1. So let us begin. So let's take an example. I have three motor cars. 1, 2, 3. Three motor cars. On January 1, 2016, total motor vehicle at cost $124,000, $1,024,000. That's the price of three motor cars out here. Let me take out my goes here. Just trying to use my laser pointer. That's okay. And the provision for depreciation on this date, on January 1, 2016, was 54250. So what does this indicate? This indicates that in the beginning of January, the total motor vehicle cost is 1,24,000 and the accumulated depreciation is 54,250 so far. Let's move further. So this cost of this golden motor vehicle is 36,000, the cost, the original cost. The question is here. The following information is also available. All the company's motor vehicle had been purchased on 1 January 2014. So all of these three motor cars, they were purchased on 1 January 2014, and the data given here is on 1 January 2016. So what you need to understand here is that from 2014 to 2016, how many years have passed? 14, 15. 2 years depreciation has been accumulated out here. This 54,250 is the 2 years accumulated depreciation. And out of these three cars, the cost of this golden car is 36,000. We are not given the cost of the other two cars. On July 1, 2016, a new motor vehicle was purchased for 48,000. The cost was settled by check payment of 20,000 and the balance by part exchange of old motor vehicle. Okay, let's understand this sentence. So we are in the year 2016. This is the beginning of the year. Our year will end in 31 December 2016. So on July 2016, a new motor vehicle was purchased for $48,000. So this is the new motor vehicle that has been purchased. This is the truck that has been purchased. Now the price of this truck is 48,000. What's the price? 48,000. So how are we going to pay? That's the question. So while making payment, the cost was settled by check payment of 20,000. We are going to make a payment of 20,000 by check, and the remaining, that is 48,000 minus 28,000, that's equal to 20,000. 20,000, we are, instead of paying 20,000, we are going to give this old car, this yellow car, we are valuing it at 20,000 and we are giving to the supplier. That's what you need to understand. Okay, so the old motor vehicle was valued at 20,000. See, initially it was purchased at 36,000. On the date of exchange, we are valuing it at 20,000. Let's read further. The vehicle that was past exchange had cost 36,000, so that's given out here. The one which we are exchanging initially, that cost 36,000. The company policy is to depreciate motor vehicle at 25% per annum using the reducing balance method. So we are adopting the reducing balance method, and the rate of depreciation is 25%. A full year's depreciation is charged in the year of purchase but not in the year of sale. So in the year of purchase we need to charge full depreciation, but in the year of sale we do not need to charge depreciation. This will be useful while calculating profit or loss on the exchange made. So basically in this question what we need to do is we need to prepare three accounts. Your three accounts, and the first account that you need to prepare is your non-current asset. Then there's your provision for depreciation account and disposal of non-current asset. So three accounts we need to prepare. So while making the non-current asset, this is your format. Look at this format, non-current asset, and you must maintain this at cost, always at cost. There's the debit side and the credit side. It's very simple. The debit side records all the increase in non-current assets. So if there's purchase of motor vehicle, you're supposed to put this side. And the credit side records reduction in non-current assets. So when you sell off, it gets reduced, so you record here. Remember, both sides must be recorded at cost, not the market price. So what did we record here? First thing, we need to have an opening balance. Non-current assets has this opening balance in the debit side. It's always in the debit side. Now if you purchase, you're going to record here in the debit side, because when we purchase non-current asset, increases. Remember, plus is this side. So when we purchase, we make payment through either cash or check. So I assume bank, and this write bank. In the bracket I've indicated it as purchase. Now in this question, from this question what we understood was we can also exchange, means we can buy a new motor car and then give off old motor car. So in that case, when you are exchanging, this is what we need to write: disposal of non-current asset account, in bracket exchange. It means if you are part exchanging or exchanging a full, write this heading: disposal of non-current asset account. So that's what you need to understand this part. So let's solve this question and find out what it really means. So in the credit side, I forgot to tell you, in the credit side we record sales. So when you are selling it off, you have to write this heading: disposal of non-current asset account. So basically, since this is a method of solving your depreciation by creating a disposal account, or I can say disposal of non-current account. Whenever you are selling it, you need to write the heading as disposal of non-current asset here. Clear? So make sure you understand this two heading. When you are doing part exchange, disposal of non-current asset. When you are selling off, disposal of non-current asset, whether you sell it off or whether you exchange it. So let's go further. So this was our question. Now we're going to start. So we are going to have a ledger with opening balance in our debit side. So non-current asset here means motor vehicle at cost, means you need to record all at cost. So first thing, we need to put an opening balance. That's this motor vehicle at cost, 1,24,000. We are making this for 2016, remember that. So at the start of 2016, the opening balance is 1,24,000. Now other thing what we need to add here is if there's any addition, that is purchase. So let's find out where the question says about purchase here. All the companies motor vehicle had purchased in 1/2014, so we don't need to do anything about this. Let's go further. On July 2016, a new motor vehicle was purchased for 48,000. Here is it. Since we're doing for 2016, there's a purchase, so we need to add this. So we write bank in the bracket, we write purchase. You can simply write bank, you don't have to indicate this, but for you to understand, I have written purchase here. So it was purchased for 48,000, but the payment was made by check, 20,000. So bank 20,000, and the remaining and the balance by part exchange of old motor vehicle. So balance means out of 48,000 we have paid 28,000 through check, so remaining 20,000 is part exchange, and that part exchange you need to write disposal of non-current asset. Remember this. So when you write disposal of non-current asset, at the same time you will have to open up disposal of non-current asset ledger. So now this ledger is going to be opened up here. See, this is your disposal of non-current asset ledger. You can write disposal of motor here. You can write disposal of motor here instead of non-current asset. So this is the ledger. Now see here, let's make a journal out of this. When you have to make a journal entry in this side, it is motor vehicle at cost account debit, disposal of non-current account credit. So it means in this ledger it has to come in credit side, or you can think it other way. If in the motor vehicle cost is in debit side, in the ledger that is disposal of non-current asset, it has to be in credit. According to our dual effect, every debit must have equal credit, so this obviously has to go to credit side. So it is going to come here now. There, see, you write motor vehicle account and put 20,000. It's coming for the journal entry. So this journal entry, make a journal entry for this two. When you make journal entry for this two, first you read the debit item, motor vehicle account debit, disposal of non-current asset credit. See, this is the same entry. So basically it's coming from this two combination entry here. I hope you understood this. Okay, let's go forward. Now what we do is we are back in motor vehicle account. What we do here is we have put the opening balance, we have recorded addition, that is purchase. Now in this side we need to record the sale. So sale here means we have exchange or motor vehicle, that is equivalent to sale. So you will record here because that reduces your total motor vehicle. And then for the sale you write disposal of non-current asset account, and make sure you record at cost. So the cost of the yellow car, remember it was 36,000, so you put here, you can see here the vehicle that was part exchange at cost 36,000. So the asset that we are exchanging or selling off, you record here because it is reducing our motor vehicles. So when you record here again, see, it is touching disposal of non-current assets. So this is in credit side. Now obviously it will come in the debit side here, this entry there. See, even there. Have you understood this? Generally for this, disposal of non-current asset account debit, motor vehicle account credit. If you read from here, it's the same thing. Disposal of non-current assets account debit, motor vehicle account credit. See, so from here the two has gone. Now back to motor vehicle account. Here we have completed this part. Now there are no other further addition or subtraction. I mean there is no purchase and sales additional. So now we need to close this account. So to close the account, you add this total up and then minus. So first let's add the debit side. When you add the debit side, it comes to 1,72,000. That has to be the same in the credit side, so you just pull it here, and then the difference you put out here. See, balance CD, and then the balance CD becomes BD for the beginning of next year. For 1st January 2017 it becomes BD year. We're not writing the dates out here because the question has said that dates are not required. See here, if dates are not required, you don't need to write the dates. So have you understood? So the motor vehicle at cost is complete. Now we focus on disposal of non-current asset, the second ledger that was required to be prepared under this method. Disposal of non-current assets is very simple. You can just think this as a normal machine or a normal asset. So in this case what happens is, in the debit side you record your increase, in the credit side decrease. So initially we had a motor vehicle of 36,000 at original cost. Now when you are exchanging it, that is equivalent to sales, that reduces our motor vehicle, so you put here 20,000. See, this is the exchange value or sale value. Now we want to find out whether we have made profit or loss by doing so. So for that we need to see the working note, which is as follows. Yeah, this is how you prepare working note. Working note W1, calculation of profit or loss on disposal of non-current asset. So the yellow vehicle, the yellow car was being exchanged, so we are trying to figure out whether we made profit or loss, and then we are adopting the reducing balance method. So here I have heading book value at beginning, at year end depreciation. This is the depreciation at year end, depreciation at the rate 25% per annum. 31/12 year end is 31/12/2000, constant date, whatever it is. So let's start. So the question mentioned that all the companies motor vehicle had been purchased on 1 January 2014. So it means that the yellow car which we were exchanging was also purchased on 1st January 2014. So we begin from that date. 1/1/2014 cost 36,000. Then you calculate depreciation. If you do 36,000 into 25%, you will get 9,000 as the depreciation at the year end, that is 31/12/2014. That's it. So at the beginning of next year now, 1/1/2015, your book value will be 36,000 minus 9,000 equals to 26,000. I'm sorry, 27,000. That's how you get a book value. So again, in 2015 year end, we will deduct depreciation. So how do you calculate this? 27,000 into 25%, you get 6750. This is how reducing balance method is done. If it was under straight line method, you will put 9,000 here. You don't need to calculate on this, beginning balance. So in reducing balance method, remember, we always calculate depreciation on the balance at the beginning of the year. So this you understood. So now again deduct 27,000 minus 6750, you get 20250 as the beginning balance on 1/1/2016, the book value at the beginning of the year. Now if you notice here, I have not written depreciation. Now why is that? Is because the question has mentioned here a full year's depreciation is charged in the year of purchase but none in the year of sale. This is the year of sale. We are selling on 1 July 2016. See here, our new motor vehicle was purchased. The cost was settled by a check of everything and the balance by part exchange. Yeah, this part exchange. The part exchange has been done in 1 July 2016. That is equivalent to sale. So on the date of sales, on the year of sales, you are not supposed to calculate depreciation as per the question. So that's why it is dashed here. And if this is 0, so you subtract this minus this, you get 2025 as it is. That is your book value on 1/7/2016. That is the exchange date. So on the exchange date, the book value of the motor car is 20,250, but remember we had valued it for 20,000 while exchanging. So that's the exchange value in the same date, 20,000. So look here, look at these two data carefully. The book value is 20,215. It means our book shows the value as 20,215. But while we are exchanging it, the supplier agreed only for 20,000. It means we are making a loss of 250. That's your loss on exchange, 250. I hope you understood this. Then we add up the total depreciation. If you add 9,000 and 6,750, you get 15,750 as the total accumulated depreciation on the exchange motor vehicle. So the asset that was exchanged, total accumulated depreciation is 15,750 for all the years. Now how to record this? That's a question. We'll go back to the disposal of non-current asset. Now in disposal of non-current asset, it is very simple. All you need to remember is in the debit side, we record the original cost of the motor vehicle that was exchanged. In the credit side, all reasons for deduction. Like this is exchange is being reduced. Now you will have to record your depreciation because depreciation also reduces the value of motor vehicle. So we are going to record this 15,750 there, and then you will add provision for depreciation in bracket motor. Means I'm trying to indicate that is for motor. If you have like 2-3 assets, you need to indicate the name of the asset here. It could be like plant and machinery, motor, furniture, that way. But if when you have only one asset, you can simply write provision for depreciation. So that's the amount here. So after this loss, okay, wait a second. Provision for depreciation we have recorded here. I hope you understood. So now when we record this, a new ledger is going to be created. That's called provision for depreciation account, which is going to be created. I'm going to show this here. Provision for depreciation account. So these are the 3 ledgers that we have created under this method. One is your non-current asset at cost. Second is your disposal of non-current asset, and the third is provision for depreciation account. These are the 3 ledgers maintained under this method. So in provision for depreciation, the opening balance is always credit. So put your balance BD here. That's given out here. See, put the balance BD. Now look at this journal entry. The journal entry for this is provision for depreciation account debit, disposal of non-current asset account credit. Provision for depreciation account debit means it's going to be recorded in the debit side, so it's going to come here. there. See, or you can simply think that it has come in credit side, so here it has come in the debit side. Very simple. If one comes in the credit, others will come in the debit always. Remember that. So this has come here. Clear? So back to our disposal of non-current assets. The reason for reduction was one, exchange, other was depreciation. Now the third is loss. Loss also reduces the value of assets, so we are going to record loss here. Okay, this is the loss 250. You will have income statement because the loss is recorded in the income statement later on. Working note 1, let's say working note 1, put a 250. So now the disposal of non-current asset is complete. You just total it up. Yeah, this is 30,000. If you add that 36,000, there is no balance CDBD. Remember that in disposal of non-current asset there will be no balance CDBD. You will not have balance. You have to be equal. So it's very simple. Record the original cost at debit side for calculating profit or loss. Then in the credit side, record all reason for deduction. Like this is exchange reduces the value of asset, this concerned asset, depreciation reduces it, and then loss reduces it. So that's complete. Now we focus on provision for depreciation of motor vehicle, the third and last ledger. So these two we know how it has come. Let's go further. Now here what we do is, on the provision for depreciation account, the depreciation for the year is recorded in the credit side. Here you write income statement and record it. So we need to calculate the amount first. So let's go to working number 2. That's very important. So here what we have done, let's see. First we have calculated accumulated depreciation for remaining motors. Remaining motors means here, what are the remaining motors? The remaining motors are your what do you call it? Besides the yellow car, the car that was disposed of. So if you look in the question, this 54250 is for all the motors that were in there in the beginning. This is the accumulated depreciation. So from that, if you deduct the accumulated depreciation of the motor vehicle that was exchanged, you get accumulated depreciation for the remaining motors or the existing motors there. Clear? So now what we do, we also find out the book value of the motor vehicle on that date. So book value of motor vehicle on 1/1/2016 is equals to 1,36,000 minus 38,500 is 97,500. Now how did you get this? That's the question. For that, now step down. Remember our motor vehicle at cost. See what was our closing balance? 1,36,000. Remember that this amount includes your opening balance of all the motor vehicles at cost. It includes the purchase is 48,000, and then it excludes your disposed of asset. So this is basically all the assets that you have remaining, including the one that has been purchased. So from that value, original cost, you have to deduct the total accumulated depreciation to get the balance on 1/1/2016. You get balance as 97,500. So in this balance, now you calculate depreciation for the year, because under reducing balance method you need the remaining balance, closing balance, to calculate depreciation. That's why we did this whole thing. So 25% of 97,500, you get 24,375. This is your depreciation for the year, which you need to record in the credit side this way. Income statement, and then you put the amount here. So that's it. That's how you do it. So basically in provision for depreciation account is very simple. You have your opening balance in the credit side, you add depreciation for the year in your credit side, and then you deduct depreciation for disposed asset or exchange asset. See, this was the part. So that's complete. Now you total it up. Total this up in the credit, you get this. The same total comes in your debit side. So this total minus this, you get this as your balance CD, and then that becomes BD for the next year's beginning. So that's how we solve disposal of non-current assets. Thank you. Please let me know if you have any queries. See you again.